let's do this.
Check this out.
On September 19th, 2008, Republican Congressman Spencer Baucus made a trade that was effectively a bet that the stock market would drop. His trade meant that for every percentage point that the NASDAQ dropped, his investment would go up by 200%. This is what's known as shorting the market, and it was actually a brilliant bet because take a look what happens over the next 4 days. Oh, and this is when he sells, nearly doubling his investment. It was an amazing trade. It was almost as if he could see the future. And that is why this report exists. This brilliant study recreates all of the trades that senators made over the course of 4 years in the 90s and found that consistently, these senators had abnormal positive returns, like way better than some of the best investors in our country.
A study of data from the 1990s showed senator trades outperform the market by 12% per year. That crushes investment guru Warren Buffett, who only managed to beat the market by 2.5% that decade.
Okay.
Per year. That crushes investment guru Warren Buffett from the 1990s showed senator trades outperform the market by 12% per year. That crushes investment guru Warren Buffett.
So there's a couple problems with this. One is Warren Buffett is a very conservative investor. So it's kind of silly to compare it to Buffett, number one. Average people are retards who shouldn't even be allowed to buy and sell individual stocks. So they're obviously going to be shittier for returns as well. So that's two. So three, it'd be interesting to compare them to other aggressive investors that run like hedge funds and everything. Number one. And number two, it'd be interesting to see it on a larger time horizon. 1990 to 1999 is a 10-year time horizon. It would be interesting to see this stretched out to more years. Are you assuming senators are aggressive investors? Yeah, don't they normally buy a lot of like individual stocks and everything? Why are they aggressive? I don't know. Anybody that buys and sells individual stocks, in my opinion, are aggressive traders. But
Work and learn how to see and understand our thought processes. That's what therapy is. BetterHelp is a...
But again, I would like to see it a larger time. 10-year time horizon is pretty pointless, no? Yes. 10-year time horizon is entirely pointless. Like taking from 1990 to 1999 doesn't really tell me anything. Because there are probably other aggressive traders in that time horizon that also did really well. Probably outperformed the 12% per year or whatever. And there's probably a lot that lost too. That's what I'm saying. It's such a short time horizon to be interesting to see it over a larger period of time. I wish there was like a name for... I wish there was a name for this. Like, I'm not saying there is or isn't necessarily something here. I don't know. But like... There's a certain type of really interesting fallacy where there's like... You have a fuck ton of data points... And then you've got like a fuck ton of relationships between like all of these different data points and the people here. And then you have a hypothesis, and then you go and you search for the relationship between these data points, and you can always find interesting things. Like for instance, like if I had like the schedule of every single person in a school, and I could see where they were at all points in time. Hold on, I'm permabanning fucking retards. It's interesting how Destiny's already making conclusions 30 seconds of video. I haven't made a single conclusion. And I literally just caveated to say that I wasn't making a conclusion. Get banned, don't ever come back. I prefer if you kill yourself. Good luck. Do you think there's no inside information in Congress? Didn't say that either. Bye. Can't wait for Destiny to find... Okay, yeah, never mind. Fuck me. This is stupid. All right. Okay, just forget this whole thing. Anytime there's huge data sets and you find anything that looks suspicious, it's always evidence 100% that there's wrongdoing happening. Full stop, no questions asked. So other than the wrongdoings, what are some possible explanations? I fail to see them actually asking. The real answer is that in any sufficiently complicated system, you could find a whole bunch of things that might be trends but aren't necessarily trends. Like I could say like every single boy that went to the bathroom between 9 p.m. or 9 a.m. and 9:05 a.m. also scored higher on like the math test given by, like you can always find this type of information. I think technically, this would be p-hacking. I think it's considered p-hacking. One thing that's really important, we read a really good article on this one time, but most of you are too fucking retarded to care about this, and I don't give a fuck, and I hope you all fucking, because you're legitimately fucking retarded. I don't think Scott Alexander wrote about this, but it had to do with like if you give people four, like three numbers, okay? Here's the three numbers that you give. And then you tell people to, and then here's what you let them do, okay? Here's what you let them do. you allow them to insert whatever number they want next, guess whatever number comes next. And then for the next number, you tell them if it's right or wrong. And then afterwards, once they've tested as many numbers as they want, then you tell them to give the pattern. And for something like this, I wish I could remember, but it was like, I want to say it was like 95% of people would get the pattern wrong. Like some people will do like 16 and then they'll say, okay, it's double every time. Some people will do, I don't know. I think the original was like 246. You're right. People will plug in like all sorts of different numbers, and then they'll guess the pattern. But the problem is that when people are doing this, what they never do is they'll never plug in contradictory information to see if something is incorrect. So for instance, 246, they'll never try plugging in like 7 because it doesn't seem to match the pattern at all. They'll never try that. But if they would have for here, they would have been told, yes, 7 matches the pattern too. And the actual answer is any number that's bigger than the one prior to that matches the pattern. 4 and 6 just happen to be random. But nobody puts in disproving information. People are saying there's a Veritasium video on it. I remember reading a blog post about it. I don't know if Veritasium did a video on it. Maybe he did. But like the real pattern for this would be, you just input any number that's increasing as true. So the interesting thing about the stock thing for Congress, this would be the most interesting, is are there any years where the average returns of Congress were lower than the normal people's, than normal traders? That would be interesting information to look out for. Maybe he did in that video, maybe he didn't. Maybe people just do the analysis, look for it, or maybe they don't. Like, are there traders that lost on average? Somebody in chat, for instance, typed in that the Pelosi fund lost. Pelosi investments, let me just look it up instead of repeating what somebody in chat said. Somebody said that Pelosi's the husband Pelosi's stock fund lost like 20% of its value or something in 2022. Was this true or not true? Holy shit. Ranking outside of the top of the 10 and also failing to beat the market was former Speaker of the House Nancy Pelosi. Well known for her stock trading disclosures between herself and her husband, Pelosi had a return of negative 19.8% in 2022. Does that include her husband as well? So, like, if that's true, that's insane. Losing 20% of your portfolio in 2022? That sounds unreal. However, if you're not looking for things that are disproving your, your hypothesis, you would never come up against this because you're only gonna look for things that are proving your hypothesis, in which case you can probably find any piece of data ever. People keep saying 2022 was an L year for the stock market. January 1st. To 22. Okay, so this means that they did about so if the stock market was down 19.5%, this means that that their returns were about average, right? But like if these people are, well, they did a little bit worse than average just on the S&P 500. I don't know what the Nasdaq and the Dow Jones sort of reported, right? But like this would be a point of data where would be like, oh well, I would have expected them to significantly outperform, especially on down years if they have like insider information or whatever, right? Maybe not. But I'm just saying that like you have to be careful when you're searching for information. You need to look for information that disproves your hypothesis as well to make sure that you're not just seeking patterns. Yeah. Analyzing results of the 12% gains study. The mediocre performance of congressional stock portfolios. Source: the Journal of Politics. Oh wait, does that analyze that study or something? Do members of Congress enrich themselves by picking stocks based on privileged political information? There's substantial anecdotal evidence they do. A widely discussed book recounts dozens of examples of members of Congress making profitable trades while in possession of non-public information about policies affecting. Another thing too, just because my background in finance, just because I'm not retarded, it wouldn't surprise me if, as a historical trader, I'm probably ahead of like 99% of professional traders in terms of my overall balance or the overall returns that I've made on my investment decisions. Now, if I was retarded, I would say it's because I'm a very smart investor. I've picked my stocks very intelligently. My analysis has been good, and I've earned those results. But the reality is that I've only made like 6 trades in my life, and I've gotten lucky on almost all of them, which isn't unbelievable. But when it comes to trading, you have to be really, really, really careful. That's why I'm saying things like volume is important. Like larger time horizons are very, very, very important to indicate like reliable stock returns, reliable performance. Do you know what your yearly percentage returns are? My yearly percentage returns are probably average to low because the vast majority of my money sits in S&P 500 trackers, whatever the Vanguard funds are. House Speaker John Boehner reportedly bought stock in health insurance, blah, blah, blah. Such anecdotes. The two existing academic studies on congressional investing, Ziobrowski et al. 2004, Ziobrowski et al. 2011, claim that members of Congress show uncanny timing in their stock trades when synthetic portfolios built from transactions beating a passive market index by 12% per year in the Senate and 6% in the House. This purported ability to, like look at this time horizon, 1993 to 1998, 85 to 2001 is a bit better, but damn, bro, Congress has existed for a long time. Like, give me some big historic averages, but I don't know, I mean. I wonder, so what is the difference in their methodology? Like, second, we argue that not only do members of Congress not systematically trade stocks at an information advantage, they also fail to choose portfolios that outperform the market benchmark. Previous work did not analyze members' actual portfolios, but focused only on synthetic portfolios built solely from members' stock transactions. Oh. Hold on. I'm trying to think if I could ever justify that methodology. I'm sorry, let me explain here. That sounds too stupid to even be possibly true. That can't possibly be, that it is impossible that that was the methodology. So let me give you an example. Let's say that I have a portfolio that's worth $1 million. And I've got 10 friends, and we all have a portfolio that's worth collectively, we'll say $1 million each, okay? So I've got 10 friends, and collectively, we've got a stock portfolio that's worth $10 million, okay? Now, of that $10 million portfolio, we'll say all of it is passive management, a term. It's invested in mutual funds or whatever for the vast majority of it. Let's say that 9 different people buy stocks of, we'll say that we spend about $50,000 on stocks. So most of it is managed by funds and shit. Let's say that we actually buy $50,000 in stocks, okay? Now let's say that we get really lucky on these trades. Now, let's say that our $50,000 in stocks appreciates to $100,000, okay? We have a 100% return on investment, all right? Now, there are 2 ways to analyze these gains, okay? What are you talking about? Hold on, Kovazian, you're in Kick Chat. You're allowed to join Discord to defend yourself, or I'm just permabanning you on every fucking platform I have. He's doing the thing he accused the video guy of doing. What do you even think I'm doing right now? Can't you just read the actual methodology? Nah, we'll just speculate on it then. I'm giving you the methodology, you retarded fucking you. What are you talking about? It's saying that it focused on synthetic portfolios built solely from member stock transactions. Do you understand? That's what I'm explaining right now. What I'm talking about is, 1, we're looking at transactions. That's the $50,000 acquisition, not the total value of the portfolio that's already invested. And now I'm talking about this 100% gain over here, which would be a synthetic portfolio that we built out of the transactions. The problem is that if you only test on a synthetic portfolio that you build out of transactions, what looks like a 100% gain in investment might only actually be a 5% gain in the actual overall value of the portfolio. That's what I was explaining to your financially illiterate fucking ass, you fucking retard. Do either of you want to hop into Discord right now and contend either of this, or I'm banning both of you? I'm trying to explain why putting together a synthetic portfolio based only on active transactions, but not taking into account the overall value of the portfolio of the investors, is a fucking retarded way to approach a study on insider trading. Okay. Goodbye. Remember, it's not down the street, it's across the highway, okay? It's funny how Destiny hates stupid smart people, but stuff. Okay. Honest question, if you were looking for insider trading, wouldn't you be looking for when they made changes to their investments rather than investments that sat? Maybe, but if the overall value of your portfolio is, say, lower than average, or say it's about average, then measuring people only on active trades they make The idea that there's some insidious insider trading, if I look at the investments of Congress and their average portfolios are about what average market returns are, it becomes a lot more suspect, right? Are they really like, is this really like a bunch of insider trading, or do some people just trade on things that they happen to feel a little bit strongly about? Like, it's just, the argument becomes much different. The initial argument was sensational, saying that their portfolios are beating the average trader by, not the average trader, I'm sorry, beating the average actively managed fund or indexed fund by 12.5 points is what they mean. That's insane. A 12.5 point average return above an indexed fund. You're like a master trader at that point. Even over 10 years, you're like a master fucking trader at that point. You should be trading professionally. You'll be beating every hedge fund in the world. But if we're only building synthetic portfolios out of active trades that are being done that represent a very small percentage of the overall account of people in Congress, then it's not as strong of an argument. Isn't there an argument to be made that these small trades with insider info is done to keep a low profile? Then, here's what we're gonna do. Okay, step 1, collect information on the market. Step 2, engage in insider trading. Step 3, make sure that your trades are so small that the average gains in your portfolio are the exact same as they would be if you just invested in indexed funds. The average congressional portfolio underperformed a passive index fund by 2 to 3% per year during the period we examined, right? So wait, are you telling me that they're insider trading so fucking hard that they're masking their gains by tanking their overall portfolio? Right? Like, in dollar terms, $100 invested, like the average investor in Congress, would have yielded $69 by the end of 2008 compared to $80 if the same amount had been invested in a passive index fund. We find underperformance using a variety of specifications and weighting approaches, and not just for Congress as a whole, but separately for both the House and Senate, Democrats and Republicans, members of power committees, members with party and committee leadership positions, and groups of members stratified by wealth, portfolio size, and turnover. In providing a comprehensive view of one kind of possible legislative corruption, our research speaks to a large literature on political agency and electoral accountability. Our main findings that members of Congress neither trade stocks at an information advantage nor choose portfolios that outperform market indices may seem surprising given extensive research indicating that politicians can affect financial markets and in some cases earn financial returns. Okay, so I want to see the methodology in this, if they really speak about building these synthetic portfolios like this. The previous study suggests that U.S. senators trade common stock with a substantial informational advantage. We apply precisely the same methods to test for abnormal returns from the common stock investments in members. We measure abnormal returns for more than 16,000 common stock transactions made by approximately 300 House delegates from 1985 to 2001. Consistent with city senator, we find stocks purchased by representatives also are significantly positive abnormal returns, albeit consistently smaller. Okay, it is. Hold on. That's so insane. I wonder if they give a justification for this methodology. Our goal in this research is to determine whether House members' investments also tend to outperform the overall market. This implies that you're going to be looking at the entire portfolio. We test whether, on an aggregate level, common stocks purchased by members of the House of Representatives exhibit positive abnormal returns. Without an information advantage, stocks acquired by House members should not outperform the market in subsequent trading days. Alternatively, if these transactions yield significant positive abnormal returns, such a finding would suggest that representatives also trade with information available to ordinary investors in a manner similar to senators. In the context of this paper, an investment return is the percentage increase in wealth that results from holding a financial asset or portfolio for a given period of time. An abnormal return is the part of the investment return that remains unexplained after most unsystemic, idiosyncratic, or firm-specific variability in returns has been eliminated by diversification, and after the return, it's just information is based on the efficient market hypothesis. EMH is theoretical. Okay. Using data available from congressional financial disclosures, we built a sample of stocks purchased by House members during the period of 1985 to 2001 using the same methodology as Ziobrowski, Chang Boyd, and Ziobrowski. What, does he have a twin fucking brother that's helping him on the study? Just for abnormal returns with a calendar time portfolio analysis, in addition to whole sample analysis, we perform subsample analysis by dividing our sample by the political party. We also build and test a sample of common stock sell transactions made during the same period. The interpretation of results from the cell sample is difficult and inconclusive regardless of the findings. Specifically, if we observe negative abnormal returns immediately after the sale, we might infer the representatives had advanced warnings of negative forthcoming information and therefore sold to avoid the inevitable losses. On the other hand, positive abnormal returns observed after the sales might suggest that the representatives took their abnormal profits off the table before the stock prices had peaked. Finally, no abnormal returns may indicate that they sold after all the positive excess returns have been squeezed out, ensured any result obtained from the cell sample can be interpreted as support for the hypothesis. Thus, we present results from the cell sample in the interest of completeness, as they are not used as a base for any conclusions. Okay, that's honest at least. Don't you think Jenk will just focus on principles? It's just good to have information. I don't know how many times I have to repeat myself. If I'm doing a debate on this topic, and all I know is this piece of information, it's fucking retarded. If you're researching for a topic, you should know peripheral information about it. This is what I make fun of video essayists all the time for, is if I'm doing a 10-minute video, there's probably like 5 hours of information I can speak about the topic. I wouldn't do a 10-minute video based on 10 minutes of research where I could speak about the topic for 10 minutes, right? You have to have peripheral information as well. Even if I don't use this in the debate, it's just good to know, right? I wonder, has there been a rebuttal to this study? Performance of synthetic hedged portfolios in Congress. Is the line here like this is probably your averages? I'm guessing that this line is this like your 95% confidence interval line? I think I understand more about this crossing the null thing too, that Vegan Gains kept saying cross the null. But now I understand. 95% confidence interval that your results end up somewhere where the null hypothesis is still within that 95% confidence interval means that you cannot reject the null hypothesis because the null hypothesis is accounted for in the 95% confidence interval that your data is showing you, right? Article is from 2015 and is looking at one very short and turbulent period of time. Oh, this guy didn't even read the study. It's Reddit, of course. Thus, its relevance is very low. Also, not everyone in Congress has chance to do insider trading because they are not sitting in relevant committees where they have first-hand. Thanks to unusual whales, we saw first-hand certain members trade in stocks that are directly responsible to regulate. Pelosi and her husband have some insane performance using highly speculative option trading. Also, they pretend to be very on point, like they know something. What was the rest of this guy's video?
These senators had abnormal positive returns, like way better than some of the best investors in our country.
A study of data from the 1990s showed senator trades outperformed the market by 12% per year. That crushes investment guru Warren Buffett, who only managed to beat the market by 2.5% that decade.
Okay. So either these civil
So this was that
super savvy-
Zabowski or whatever fucking the 2004 study. Ziobowski. I don't know fucking write this fucking guy's name. Oh. Because he looked at time periods from, this was the Senate from 93 to 98. I may have missed something, but why not just concede the point that sure, what they are doing should be stopped, but currently it's not illegal and this problem is low on American voters' list of grievances. This is my problem with you guys. And I never know, I lose this every single time. I've got to figure out a way to rhetorically like thread the needle on this because you guys are so fucking retarded. Something will happen on a continuum of good to bad that is bad. This thing will happen. And then I'll make a statement where, okay, this thing will happen and this will be the response. It'll be this response. And I'll make an argument. I'll say, hold up. I don't think this thing was this bad. I think that our response should probably be proportional to the thing. And then when I make this argument, everybody just says like, oh, so you think this is good. So you think this is fine, right? Oh, so you thought it was okay that the guy pulled the wig off the lady. Oh, you don't think anything should have happened to him. You think she should have just toughed it out. Like, no, I'm not saying that at all. I'm just saying that like this reaction is inappropriate. Should Congress be allowed to trade stocks at all? Maybe not. Maybe the look is just so bad that even if there is no data for there being corruption, maybe they just shouldn't be allowed to because it just fucks with everybody's confidence in Congress in general. That's an argument that one could make, but that's a far different argument than, oh, they're currently enriching themselves doing illegal trades right underneath everybody's noses and nobody's doing anything to stop it. You understand that those two things are massively, wildly different.
Yo.
Hi, what's up?
Yeah, so you were talking about insider trading and ways to test for it, and you were looking at a bunch of studies, right? You had a bunch of problems with the methodology. So yeah, you're right, but the thing is, you have to use multi-pronged tests because it's just not possible. So if you take a sample of all of Congress, on average, you would expect the average person in Congress isn't insider trading. So if you're to say that, okay, well, we looked at Congress and Congress sucks at trading, well, that doesn't excuse Congress or individual Congress people from being able to do it, and neither does individually timing like a single trade, like you were saying.
Yeah, theoretically, they could be insider trading some stocks, and they could be manual trading other stocks, and the shittiness of their manual trades could like cause the like moral wrongness of their insider trades to theoretically be lost, right?
Right. Yeah. So it's just not possible through academic papers to get any insight. You would have to have.
Well, it would be
like, an
possible, but
investigative
you would have to. It would have to be like a more in-depth, like on an individual, right?
Yeah, well, I guess you don't have access to it. There's some interesting papers they did for insider trading. I want to say it was in Malaysia because that was a market where it actually happened. But for American congressmen, I don't think it's happening nearly that much. It just kind of comes in little bits and pieces if it does. And it's more so the appearance of wrongdoing, more so than they're actually doing this on a systematic basis, because that would just actually ruin the market and people wouldn't come participate.
Yeah, I mean, I agree. The appearance of wrongdoing is probably enough to do something about it. But there's a difference between saying there's an appearance of wrongdoing versus we absolutely know that there is widespread wrongdoing, right? Like those two things are.
We would know that we would actually see drops in market efficiency if there was widespread wrongdoing, and we don't see that in America, but we do see it in other foreign stock markets.
Wait, when you say drops in market efficiency, are you saying that because people would just be emulating congressional trades, or?
Well, people would just pull out of the market because they know that somebody else has insider information, and so you.
Well, just because you can't beat an inside trader doesn't mean that you still can't make more money in the market than in other places. Like if I knew that there were insider traders that were guaranteed 20% returns on their trades, but I know that my trades are going to be like treasury bonds or whatever, I would still trade, right?
Yeah, but you would see a drop off as people would be less willing to participate because they know the guy on the other side of the trade is more likely going to be winning from them. Right?
Well, but then where would people put their money?
Well, for those countries, they go to other markets. So they might go to like London or something like that, as opposed to American markets. It's less of a problem, I guess, for Americans, but that's what happens. They just don't participate in those countries' markets anymore.
But you're talking about Malaysia versus the U.S. economy.
Sure.
Do you think people in
Sure.
the United States economy, no, I don't buy
Yes,
this.
yeah,
Even
you
if
would get-
every single person in Congress was insider trading, I don't think that people would just stop investing in the U.S. economy. I super don't believe that. No, because if you take all of the portfolios of everybody in Congress together and you add them up, is accounting for a fraction of the percentage. Like even if insider trading exists, you're still going to be looking at U.S. investments beating on average like other investments you can make around the world, right?
Maybe. I would say on average, the rest of the world should be beating American investments because they should be catching up at technology and everything else. But yeah, all else equal, America's a great place to invest, and the average congressional portfolio is small. But if they're persistently winning, you should see a decrease over time because their portfolios should be getting bigger, and there's less people who will participate because of the cheating behavior.
Yeah, but even if their portfolio is getting bigger, like it's never going to be a sizable. Like
I don't know about that. Some of them have literally hundreds of millions of dollars.
Hold on, wait. You say
really
some of them.
cheating
Isn't that
features.
literally like one of them? Isn't like Nancy Pelosi like the richest person? Like, here's a question. If I were to look up average size of U.S. lawmakers' portfolio, what do you think the number would be?
Probably between 5 and 15 million for average. Mean is probably going to be closer to 2 to 5 if I had to guess.
Okay. My guess would be around like 1 to 3, but we can check, I guess. Average, well, they're a lot older, so it might skew a little bit higher because of how old they are, actually. So maybe 5 million. Average size of Congress portfolio stock market. I don't even know. Do they have to report their total holdings or just their trades?
I think there's disclosures for each one for everything that they own. So like all their houses, all their properties, everything. And it's the same thing for a lot of the Fed directors and other people in those positions. They're supposed to report their net worth.
As of 2020, over half the members of Congress were millionaires, and the median net worth of members was approximately 1 million. Okay, so I think it's even lower than I thought. If a little bit over, so a little bit under half of Congress don't even have a net worth of $1 million. This says here, this is from Ballotopedia, the latest batch of numbers shows the 113th Congress had a median net worth of $1 million. So these portfolios are never even remotely close to reaching things that would affect like the entire market.
Sure. I mean, I guess if you do it directly through them, but then if you include their family or their aides or other people who would have it and they started rampantly cheating, I think the impact would be a lot bigger than what you would think.
Okay, I don't believe that at all, but I don't know. I mean,
Okay,
yeah.
that's fine.
Sure. If they were to start to make up like a sizable portion of the stock market, because in my opinion, the question, because you seem to be framing the question as though like, are you beating the insider traders? But I don't think people care if they're beating insider traders when it comes to investing. They just care that they're choosing the best option, risk adjusted for their investment. Like, let's say that you found out again, let's say even 10% of the stock market was rigged. 10% of traders were enjoying returns that were 2 times as high as the average trader. It's not like I'm about to just like pull my money out completely and just let it devalue to inflation, or just go invest in like a savings account or a money market deposit account. Like, I'm still going to want to enjoy my 10% annual returns, even if I know other people are beating me.
Yeah, you might go to real estate, you might go to European markets.
Only if those markets are beating my ordinary indexed U.S. returns. Like if my ordinary returns that are indexed to U.S. markets are still 10%, just because some people are insider trading earning 20%, doesn't mean I'm about to go invest in European markets giving me 7% because I'm upset that insider traders are beating me, right?
The answer you would think would be yes, but I mean, just look at what's happening with GameStop and that everything else. Like there's
Well, hold on. You said everything else.
Yeah,
GameStop sentiment was crazy based on stupid derivative markets and sometimes investor sentiment. But
it's not even that. That's expanded to a lot of other thinly traded stocks where you've just seen a ton of market makers pull liquidity and no longer trade anything besides the most liquid contracts.
Yeah, I understand what you're saying, but again, you're saying thinly traded stocks with low liquidity. We're not talking about we're not talking about index like major funds or anything.
Yeah, we're talking about even things in the S&P 500. They're losing market makers because no one wants to take on that risk anymore because of the one-sided retail.
Wait, hold on. You're telling me that in the S&P 500 there are market makers that won't make those trades? Is that true?
Yes. So there are dedicated market makers for S&P 500 stocks, but other firms historically have competed, especially in the less liquid ones, because there's more profit to be made when there's wider spreads. A lot of these market makers and other firms have decided that the risk associated with the retail trading phenomenon has caused them to pull liquidity and pull trading on lots of pairs, some of them even up into like the S&P 500. And so they're not participating in markets that they otherwise normally would have made because of that existential risk.
So right now, are you saying that there are stocks in the S&P 500 that if I wanted to buy $100,000 worth, it would take me days to make these trades? The liquidity's not there for it.
No, it wouldn't take you days to make the trades, but there's going to be slightly more slippage and there's fewer participants in that market, which is indicative of that risk that's there. The same way that you would see liquidity being pulled or things like that if there was this insider trading bid from Congress, even if it's not on a surface level there, but that market impact does exist, and you would see that in the order tapes and everything else in the same manner that you do from GameStop, and you don't see that activity. So
if you have like an article, even like a Financial Times or Wall Street Journal, I'd be curious, or Bloomberg, because the idea that market makers are not satisfying trades or not guaranteeing trades for S&P for like majorly indexed companies.
So it's not that they're not guaranteeing trades, it's that the trades are slightly worse than they would be otherwise. And so the impact on the average investor is going to be minuscule. The overall market has shifted as a result of it. And you would
what do you mean the trades would be slightly worse otherwise?
Okay, so let's say right now, let's say that there's like a 5-cent spread on something. If we were in another world where GameStop didn't happen, that spread is probably going to be closer to like 3 cents. Or if your $100,000 would have bought you 100 shares, then now you're probably only buying like 99.8 shares.
Sure.
So the impact on you might be small, but you can measure the impact of these firms leaving the market on competitiveness and liquidity in those specific areas. And so even
but isn't that just going to be relative to the volatility of whatever security we're talking about? My guess is that like the spread on like Apple or Amazon is still probably very, very, very low, right?
Well, yes. And so the most liquid stocks and the ones with the greatest depth in market have seen more competition as people are moving to those because they're not afraid of that retail behavior. And so all the market makers that were allocating capital down the list because it was more profitable then, that market behavior of retail and GameStop has made that risk too much, so that money that they're allocating there is actually going to the most liquid stocks like Amazon, Apple, S&P 500 contracts,
Okay.
and less down the chain.
Yeah, so I'd be interested if you can leave me an article. I believe what you're saying. I think that like I feel like our disagreement right now, and I'm making this with no foundation at all to be clear, but like when you tell me that like this is happening with securities listed on like the Dow Jones, the Nasdaq, the S&P 500, that some market makers are moving up the chain.
Dow Jones is top 30, but
okay, but on like the S&P 500, that's 500 companies, right?
Mm-hmm.
How many are listed on the Nasdaq?
I want to say, well, there's a ton depending on if you want to count the over the things, but there's a lot. Nasdaq's probably the largest.
Sure. Okay. So the S&P 500 is about 500 securities. I would be curious if there are market makers, or if like the spread is actually growing on companies listed on the S&P 500. I'd be curious to see if that's the case. But
yeah, but I
but
guess
also
like the point that I'm
because
trying
there's
to
other
make
things too.
is
Like
that-
there's a constant looming fear of a recession. We had like multiple bank failures. Like I don't know if like has GameStop happened with anything else? And also the GameStop stuff too.
So it's not the.
Wasn't that
it's
largely
not-
driven by like derivative markets?
A little bit was driven by derivative markets.
Wasn't like
but a
all
lot
of it?
was just driven by group investor behavior.
Yeah,
Like,
but the
that's
group investment behavior was based off of like shorting the stock, right?
What do you mean? There's been other stocks that have been shorted just as much, and I guess I've had a couple short squeezes, but it's more so the fact that investors are looking to just like attack short positions over and over and over, and that specific one. Let me think if I can. So like Volkswagen blew up. That was like a big one around 2008. I think that spiked to like $1,000 per share, but there wasn't a persistent narrative in the investing public to go out and then try to hunt down every short position in every other thinly traded stock the same way that there was with the GameStop phenomenon.
Yeah, but Volkswagen was fundamentally different because it was another European car manufacturer, right? That had managed to like consolidate a whole bunch of different companies that owned outstanding shares in Volkswagen. That was driven by like I think one company that had kind of like sneakily bought up a ton of the that was a lot different than GameStop, where it was derivative trading that was driven by retail investors. Like that was wait, hold on, I'm so sorry. I might be fucking retarded. Or shorting and shorts and puts, is that not considered a derivative market?
Puts are considered derivative markets, yes.
Shorts are not derivatives?
Shorts are not derivatives. They're
Oh, weird. Okay.
yeah.
Okay, but still, not just trading on the stock itself, but on shorts. It feels weird to say that because this happened with GameStop via shorts, that now ordinary trades on other stocks in the S&P 500 are. Yeah.
It's not just because it happened to GameStop. It's because they then went and tried to find every single other thinly traded stock with high short interest, and the objective was to make money by blowing out shorts wherever possible.
Sure.
And as a market maker, you are naturally going to end up with like longs and shorts depending on you're just taking the opposite side of whatever the order flow is for the day.
Yeah,
And
but wasn't that largely a failure? Like people went around, they tried to find anything with high short interest. They tried to squeeze a few things.
I mean, it worked on AMC that went up catastrophically.
Yeah, but this was but it was for a small period of time following the GameStop explosion. But then after that, like, hasn't most of this like largely died off?
Yeah, sure. And a lot of it was because a lot of market makers pulled out, and those are the people who had a lot of the biggest exposures. And there's still the whole cult subreddits and everything that are still trying to weaponize retail traders the same way on these thinner traded stocks and things like that.
Well, hold on. You keep saying thinner traded stocks. If we're talking thinly traded stocks, I can agree with you. But S&P 500, anything on the S&P 500, my guess is it's not going to be thinly traded, even at the bottom of that index.
It's still pretty thinly traded.
Can you quantify that for me?
Relatively speaking, to
I'm throwing out bullshit numbers, but like my understanding would be that on the S&P 500, I could buy or sell $10 million of stock in an instant on anything listed on the index. Is that true or false?
Just, take a look. No. Well, yes, you could buy and sell $10 million, but you're going to see a price movement further out. So on Apple, if you're selling like $10 million worth, you might see like 10 or 20 basis points. And if you're way down, I think some of those companies are only like $500 million or $1 billion. You'll see significantly larger moves. And then those moves have been
okay, sure. So 10 million might be pretty high, but the spread is going to be relatively low, and you can still there's very high liquidity all the way through like the S&P 500. No.
Oh, I guess, yeah, relative to what any normal investor would do, yes. But
Okay,
in terms
actually,
of
wait, hold
where
on.
it
I
was
take that
compared to
back.
2 years
Maybe
ago, it's gotten smaller.
I'm sorry. Hold on.
Or
I
it's
take that
gotten
back.
larger, sorry.
I take that back. I think 10 million that would be my guess. Hold on. Somebody said in chat. Proteus says the smallest company in the S&P 500 is still $10 billion market capitalization. So I feel like, what is the, like, if I look up like smallest company on S&P 500 index,
So 13 billion is now what it is.
what's
And
what's like the ticker?
Oh, that's just what the minimum is. Go to 504's Dish Network, DISH.
Dish Network.
And so,
What was the trading? What was the volume today?
so
I'm just curious.
today's volume was 70 million.
Okay. Over how many trades? Does it say, or?
I can dump it. I guess I can't dump it into chat because I'm banned. But see, Dish Network stock price.
Or I guess you can just calculate the, because this is
I
like
don't have an order
it's a
book in front of
$3
me,
billion
but-
company. The price is about $7.48 a share, and it looks
Yeah,
like, is
so-
volume listed in shares traded, or is it listed in dollars spent? I'm guessing
I
volume is
believe it's
listed
in
in shares traded, right?
no, well, no, it's 9.9 million shares traded, which is about 770 million.
Okay, yeah. So over 10 million shares of this traded today. Not a huge. So like, yeah, I don't know. I guess the way that you're talking, you're making it sound like market makers are like pulling out of guaranteeing trades at stuff at the bottom of the S&P 500, and you're
Well,
starting
those-
to see like
you still
huge
have
fluctuations in price.
They
Yeah.
still have dedicated market makers. And when I say that, it's relative to where it was before or where it could be in terms of market improvements.
Sure, but is that all
So-
blamed on GameStop, or is it like this looming worldwide recession plus energy crisis plus war in Ukraine plus bank failures? Like, I feel like that stuff is probably like
I've been in
yeah, go ahead.
specific conversations with a lot of people, and a lot of these smaller market making firms have specifically pulled out because of GameStop and the other risk associated with it. But yes, there's other confounding factors which make it more difficult to measure. The people who have the actual ability to measure that impact would be the SEC or FINRA, but none of them have a lot of interest or ability to, because there's a lot of other fundamental issues that they're looking into the market, or I guess the SEC. But my guess is if you had access to the trade tape and you had access to all these firms' data, you would see that there is an impact coming from it. And that you would see the same thing if you were having true insider trading by Congress. You would see significantly greater impacts on the market than anything you see right now. Like, it would be measurable.
Okay.
Yeah. All right. Yeah, that's just basically it. Hope you have a good stream.
Yeah, I love you. I'll be right back. I'll be right back. 1 sec, guys.